Hello, I'm Phillip Smith, financial planner with Tide Pool Wealth Strategies, guiding late career professionals into and through retirement with clarity, confidence, and purpose. Welcome to
The Perfect Retirement Plan?
So, you just Venmo'd the last college tuition payment, the refrigerator is strangely full, and your checking balance no longer evaporates on violin lessons and soccer cleats. What do you do with that newfound money in your 50s and early 60s? Today, we'll tighten the focus to 5 razor-sharp moves that can push tens, even hundreds of thousands of extra dollars into the places they'll work hardest before you shut down the work laptop for good. Now, big spoiler alert, stuffing the cash under a mattress is not on this list unless you enjoy negative real returns and dust bunnies, which of course I do not. Here's the roadmap for today's episode. First, we'll discuss supersizing the standard and enhanced catch-up contributions. Second, how to use your low-income, quote-unquote, tax valley for bracket-friendly Roth conversions. Third, a tip on mastering asset location. No charts, just plain English. The fourth stop will be turning an HSA into a stealth triple tax-free retirement bucket. And then the fifth tip today will be on how to fund a taxable, quote-unquote, bridge account so you can control cash flow before Social Security starts. We'll wrap with a quick note on the mythical mega backdoor Roth. It's not a myth, but it is a rare bird. And we'll talk about why I don't lead with unicorns. Let's jump in with both feet. Tip number 1, supersize the catch-up contribution and the new super or enhanced catch-up. If your grocery bill finally shrank because the kids are adulting, it's time to redirect those dollars you've been spending on sustaining them. Standard 50-plus bump in 2025, the elective deferral limit is $23,500 plus $7,500 for a catch-up contribution, which equals $31,000 that you can put into your 401k or 403b. Now, IRAs jump from $7,000 to $8,000 with the $1,000 catch-up. Then there's the super catch-up, or what's referred to as the enhanced catch-up, which is specifically for ages 60 to 63. Secure 2.0 lets you kick in 150% of the standard catch-up, or $10,000, whichever is larger. So this year, that's $11,250 extra, raising your potential 401k stash to $34,750 for those 4 golden years. In each of those 4 golden years, I should point out. Now, relatable reality check. Channeling the $700 a month once spent on a teenage man-boy's groceries into the enhanced catch-up from ages 60 through 63 can pile up roughly $60,000 by your first RMD, assuming 6% growth rate. Think of the enhanced catch-up as an empty Costco cart. Overflow it while you can because the deal disappears at 64. Here's a quick checklist to help you with this. 1, automate the payroll bump. Don't rely on January willpower. 2, coordinate this with any other retirement savings, FSA or HSA funding, so every dollar lands in its highest impact slot. That was truly a quick checklist. Tip number 2, use your quote-unquote tax valley for Roth conversions. The years after your final paycheck and before RMDs typically create a lower income valley. Converting slices of pre-tax IRAs to Roth IRA money while you're in the modest brackets can shrink future RMDs and the taxes they trigger, and also lower Medicare IRMAA surcharges and keep more of your Social Security untaxed, and it passes to your heirs a tax-free legacy. I've worked with multiple clients where our planning software models 6-figure lifetime tax savings numbers and 6-figure increases in total spendable wealth over their lifetime. So aim to fill, not overflow, your current bracket. We want champagne taste on a beer budget tax rate. Tip number 3, put the right assets in the right buckets. This is what we refer to as asset location. Asset location. I almost always get tripped up and try to say asset allocation. This is asset location. Picture your savings sitting in 3 buckets on the patio. First is the tax-deferred bucket, your pre-tax 401k and traditional IRAs. When sourcing for income in retirement, these are the most inefficient accounts from a tax perspective. Anything that spits off regular interest or hefty income belongs here. Think bond funds and REITs, real estate investment trusts. Mutual funds that are prone to realizing capital gains every year are also a good fit for this. Since Uncle Sam will tax those dollars as ordinary income later, you might as well shelter the earnings now while they compound. Next comes the taxable bucket. This is for investments that already get a friendly rate like stock index ETFs or municipal bonds. Hold them more than a year and you pay long-term capital gains tax, often 15%, sometimes even 0%, but a max currently of 20%. Keep turnover low and this bucket can stay crystal clear. Finally, the Roth bucket. In other words, the tax-free bucket. This one has a leak in the best possible way. Every drop you pour in plus all the growth can spill out tax-free someday. That makes it perfect for the turbocharged stuff. High growth stocks, broad stock indexes, anything with long runway growth potential. Morningstar research says sorting your dollars into the right buckets can boost after-tax returns by about 0.25% per year without changing a single investment pick. There are other sources that put the number at 0.3 to 0.5% annually, so up to 0.5% per year. That is an increased potential for performance, plain and simple. I guess you kind of say it's like laundry day. Whites go in the hot water, colors in the cold, mix them up, and your favorite shirt fades faster than your after-tax return. And your whites get dingier much quicker than you'd prefer. Laundry. Anyways, tip number 4, superfund your HSA and let it ride. For 2025, you can sock away $4,300 as a single person on the plan, or $8,550 if you're on that family membership, plus a $1,000 catch-up at 55 and above. Here's a way to handle it right. First, pay today's doctor bills from checking. Scan those receipts. Second, invest the HSA aggressively, or as aggressive as you're comfortable with. Growthy investments, not idle cash. Third, reimburse yourself decades later, tax-free, pocket the growth. 10 years of max family contributions at 7% growth clears $120,000 of tax-free money for Medicare premiums, long-term care insurance, or even a new knee. Every receipt is a future IOU. Write it today, cash it tomorrow, it's tax-free. Time travel for medical bills. Okay, tip number 5, build a taxable bridge account. Many clients retire at 62 or want to and try to delay Social Security to as far as 70. They need flexible dollars to bridge that income gap. A beefy taxable brokerage account creates cash flow taxed at 0, 15, or 20% long-term capital gains rates when you do it right. It also lets you keep IRA withdrawals low, preserving the Roth conversion valley, and it can potentially reduce sequence of returns risk by sparing retirement accounts in early down markets. Ryan from the Money Guy podcast calls it tax diversity on steroids. Here's a launchpad idea for this if you haven't started one of these accounts. Shovel annual bonuses, RSU proceeds, or freelance income into an automatic monthly transfer and let the bridge build itself. Think of it as, I don't know, like a boardwalk between your last salary and your first Social Security check. No swimming with the sharks when you build that thing right. Okay, so bonus tip, the mega backdoor Roth, that rare bird with a really big wingspan. I guess I could give you this rare bird bonus. If and only if your 401k allows after-tax contributions and immediate Roth transfers, you could shuttle up to $77,500 if you're age 50 plus, or even $81,250 if you're 60 to 63 specifically, into Roth territory for a year like 2025. Powerful, yes, but only about 1 in 10 large retirement plans supports every step of this process. That puts this somewhere in the ballpark of less than 5% of all 401ks in the US. Don't lose sleep on this one. The 5 tips I discussed move the needle for nearly everyone. And now, let's take some action. Next Monday, boost payroll deductions to capture the full standard or super catch-up/enhanced catch-up contribution. Over the next 2 weeks, try running a multi-year tax projection or have your advisor do it for you to size a Roth conversion without breaching your tax bracket. The next time you rebalance, audit your asset location. Surfers in the Roth, urchins in the IRA, anemones in the taxable account. Shift smartly. I don't know if that works, but we're going to go with it anyways. Quarterly, you should sweep idle HSA cash into index funds if you do not work with an HSA bank that does this kind of thing automatically for you. And then, of course, as you have medical bills come up and you pay them, archive those receipts. And ongoing, make an effort to auto-transfer surplus payday cash to your taxable bridge account. Simple practices are the best practice. And I should be in the practice of nailing the disclosures. I do believe I missed a couple, and I'm trying to catch these before compliance does. So here we go. The hypothetical investment results in this episode were for illustrative purposes only and should not be deemed a representation of past or future results. Actual investment results may be more or less than those shown. This does not represent any specific product, and converting from a traditional IRA to a Roth IRA is a taxable event, and all investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. I'm sure people have tuned out by now. And that's crazy because I close every episode with a speed reading version of a disclosure that took me a full 30 seconds to get through, and if none of these ones were in it. So, thank you, listeners, for exploring these tips with me and bearing with the disclosures. Please feel free to subscribe and don't conceal this if you found it helpful. And remember, it's not about having the smartest financial advisor, the most money saved, or the highest probability of retirement success. The perfect retirement plan for you is the one you act on.
It's disclosure time. This podcast is intended for educational purposes only, should not be used for any other purpose. The views depicted in this material should not be considered specific advice or recommendations for any individual, are not intended to be financial, tax, or legal advice, and do not represent Type Pool Wealth Strategies or Cetera Advisor Networks, LLC. For a comprehensive review of your personal situation, always consult with a financial, tax, or legal advisor. Neither Cetera nor any of its representatives may give legal or tax advice. Our office address is 450 Country Club Road, Suite 350, Eugene, Oregon 97401. Securities and advisory services are offered through Cetera Advisor Networks, LLC, a broker-dealer, registered investment advisor, and member of FINRA and SIPC. Cetera is under separate ownership for any other named entity.